Welcome back. Crude futures edged up in early Asian trading today following heavy losses in the previous session after official data showed that U.S. inventories rose for the first time in 10 weeks, reawakening concerns over a glut. U.S. crude futures were up 24 cents at $45.98 a barrel. On Wednesday, they closed down 5% in the previous session to the lowest settlement since May 4. Brent crude prices were 29 cents higher at $48.35 a barrel, having fallen 4% in the previous session, also the lowest since May 4. U.S. stocks of crude oil and gasoline surprisingly rose last week as refinery runs declined and exports fell. Crude inventories rose by 3.3 million barrels in the week ended June 2, compared with expectations for a decrease of 3.5 million barrels. All right, let's bring in Ada Akonobi, research analyst with Financial Derivatives Company here in Lagos, for more on the oil market. Hello, Ada. Thank you very much for joining us.
Hello.
Oil prices are still trading below $50 per barrel. What are really the major drivers?
Well, oil prices started to trade a bit higher today, but prices are coming down downwards now, and this is mainly driven by the data coming out from the U.S. So the U.S. Crude inventories, there's been a major increase in the crude inventories and the gasoline inventories as well. So, I mean, that just drives sentiments that seems like the oversupply is going to be here for a very long time. So, I mean, that is what is driving prices right now, and we expect prices to continue in this momentum.
Now, with current oil prices at $48 per barrel and 2017 budget oil price benchmark, that's for Nigeria, at $44 per barrel, what is the implications for these budgets now?
Typically, when the budget was set, oil prices were trading, most international organizations expected oil prices to average trade comfortably above $50 per barrel in 2017. However, what we're seeing, the reverse is the case. Prices are $48, now $47 per barrel, and our budget benchmark for 2017 is $44.5 per barrel. So typically, if there's a spread between the budget benchmark and the international oil prices, whatever is made inside goes into the excess crude account. So if we see prices going lower, that means whatever we are going to have to save for the rainy day will begin to shrink, and that will have to. It seems like the policymakers may have to go back. I mean, if oil prices continue at its in the negative territory, they have to go back to adjust most of the assumptions that we based for $50 per barrel. And again, I mean, adding to that, it may have to the CBN as well. If we have lower oil prices, the CBN may actually find it difficult to continue to support the naira because higher oil prices, and if our production are up to par, I mean there's going to be more dollar inflows which the CBN will use to continue to fund the market.
So if this happens, what will that mean for Nigeria's foreign exchange market?
Yes, exactly. Now the naira to the dollar rate is about 366, and this is mainly driven by the CBN's new incentives to allow banks to trade excess FX positions among themselves. So what we're seeing, there's a lot of dollar liquidity, but then there's a lot of this naira illiquidity. So that is what is driving the exchange rate market for now. Like I tried to reinstate earlier, if we remain at the negative territory in oil prices, it will have to affect CBN's ability to continue to defend the naira. But so far, the market is yet to, price that in. And we're having lower oil prices as well because it seems like the market is beginning to factor in the fact that Forcados is coming back on stream. However, so far, the production capacity for Forcados, which is a top export oil grade, is about 300,000 barrels. But now they're just producing about a third due to there's still a bit of operational issues which needs to be addressed. But I mean, all hands are on deck, and production, Forcados should be able to bring our production back up to 1.9 million barrels per day.
Yeah, talking about Forcados coming back on stream, what would that now mean for Nigeria's oil market in terms of production and, of course, our export?
So we have higher production, The latest OPEC reports showed our production was about 1.9. So Forcados is going to come back on stream with a production estimate of increasing our supply to about 1.89 million barrels per day times current oil prices. What we're going to see is there's going to be a lot more dollar. I mean, that means financial costs will be a bit robust. Yeah, so that's good news. Forcados coming back, and there talks about other force majeure as well that's going to be lifted up in future. So that's going to bring our production back up to possibly our target. But for now, prices are still slowly picking up.
Now, do you think that the Forcados, Nigeria's Forcados coming back on stream would have any implication for OPEC's decision to cut production?
I personally don't. I mean, we don't expect that to happen. Nigeria and Libya are still part of the countries exempt from, curbing our production. But I believe that if we continue at the pace that we are, if we exceed our production benchmark targets, then we may have to, fall in line with others that have been exempted. But for now, I think we are still going to, sail through.
All right, so what do you see to be the outlook for oil prices for the second half of the year?
The oil market is extremely interesting, and when we started the year, we forecasted that prices would stay at about 55.60, but now other market forces are driving prices. A lot of international organizations have their various forecasts. Wood Mackenzie, which is an oil consulting firm, expects oil prices to average $60 per barrel this year. The International Energy Agency as well expects oil prices to trade about $55 to $60 per barrel. But then we have to, continue to factor in Trump's oil policy. The U.S. production has gone up 10% compared to what it was yesterday. The U.S. oil rates are 20. The oil rates have been increasing for the 20th consecutive weeks, which is the longest streak in almost a decade. And we have soft demand in China as well. China is the second or first largest energy consumer. So if you have the forecast or the concerns of oversupply still in the market, and top energy consumers are going through slow growth, so we're going to have to expect our prices to remain soft. So our forecast still remains between $50 to $55 per barrel. However, the oil price environment is still very exposed or open to a lot of geopolitical tensions or unforeseen circumstances. But for now, we expect prices to trade. Average prices for 2017 to be around $50 to $55 per barrel.
All right, Ada. Thank you very much. Enjoy the rest of the day. Ada, Economy Research Analyst with Financial Derivatives Company. We move on now to precious metal. Gold edged lower today as investors awaited cues on market direction amid a number of geopolitical events later in the day that could boost the safe haven demand for the metal. Spot gold was down 0.2% to $1,284.24 per ounce in early trade. U.S. gold futures for August delivery dipped 0.5% to $1,000.